How do municipal bonds compare to Treasury bonds? Have you ever wondered how municipal bonds stack up against Treasury bonds? Both are popular choices for investors looking for stable returns, but they have some key differences. Let's break it down. First, let's talk about risk. Treasury bonds are often seen as the safest investment in the United States. They are backed by the full faith and credit of the federal government, meaning they carry almost no credit risk. On the other hand, municipal bonds are generally safer than corporate bonds but come with a bit more risk. They are backed by the issuing municipalities, taxing power, or specific revenue streams, which can introduce some credit risk and interest rate risk. Next, we should consider the return on investment. Treasury bonds usually offer lower yields compared to municipal bonds. This is due to their lower risk profile. However, Treasury bonds provide more stable and predictable returns. Municipal bonds, in contrast, often provide higher yields, especially when you factor in their tax-free income. This makes them particularly appealing for investors looking to minimize tax liabilities. Speaking of taxes, let's look at the tax benefits. Interest earned from Treasury bonds is subject to federal income tax but is exempt from state and local taxes. Municipal bonds, however, are generally exempt from federal income tax and often from state and local taxes as well, depending on where the investor lives. This tax-free status can significantly boost the after-tax yield for municipal bonds. Now, let's discuss market dynamics. Treasury bonds are highly liquid and widely traded, with their yields closely watched as indicators of overall market conditions and interest rates. Municipal bonds are less liquid but still widely traded. Their yields can be influenced by local economic conditions and the financial health of the issuing municipality. When it comes to investment strategies, both municipal and Treasury bonds can play important roles. For banks and credit unions, municipal bonds can be attractive due to their higher yields and tax benefits. However, it is essential to carefully select them based on the issuer's creditworthiness and the specific project or revenue stream backing the bond. Treasury bonds are often used to stabilize portfolios due to their low risk and high liquidity, making them ideal for managing risk and maintaining cash flow. In summary, both municipal bonds and Treasury bonds have their advantages and disadvantages. The choice between them depends on your risk tolerance, tax situation, and investment goals. Understanding these differences can help you make informed decisions in your investment strategy.